The latest report on the U.S. economy reveals a surprising upturn, with a robust growth rate of 2.8% in the second quarter of the year, surpassing expectations. This positive development comes despite the ongoing challenge of high interest rates. The acceleration is driven largely by consumer spending and business investments, showcasing the economy's resilience. Meanwhile, inflation rates have shown signs of easing, although they remain above the Federal Reserve's target. This dual trend of growth amidst inflation moderation raises hopes for a soft landing, where the economy can stabilize without slipping into a recession. As we witness these developments, one might wonder, can this balance between growth and controlled inflation be sustained, or are we on the brink of new economic challenges? The U.S. economy demonstrated unexpected resilience in the last quarter, growing at an annualized rate of 2.8%. This growth, significantly higher than the 1.9% that economists had anticipated, reflects a robust performance in the April-June period. The data from the Commerce Department suggests a notable acceleration from the previous quarter's 1.4% growth rate. This positive trend, fueled by both consumer spending and business investments, comes at a time when high interest rates continue to be a significant factor in economic planning. One of the critical aspects of the report is the ongoing adjustment in inflation rates. The Federal Reserve's preferred measure of inflation, the Personal Consumption Expenditures (PCE) Price Index, showed an annual increase of 2.6% in the last quarter, down from 3.4% in the first quarter. When excluding the volatile food and energy sectors, the core PCE inflation rate increased by 2.9%, also a decrease from the previous period's 3.7%. These figures indicate a deceleration in inflation, although they remain above the Federal Reserve's 2% target. The context for these economic metrics includes a backdrop of persistently high interest rates, which the Federal Reserve has employed as a tool to curb inflation. This approach aims to achieve what economists term a soft landing, where the economy slows enough to reduce inflation but avoids tipping into a recession. The recent GDP growth figures provide a glimmer of hope that such a balance might be achievable despite the complexities involved. Consumer behavior has been a significant driver of this growth. Despite higher borrowing costs, consumer spending has remained robust, reflecting a resilient labor market and strong wage growth. This spending is a vital component of the GDP, accounting for approximately two-thirds of economic activity in the U.S. Businesses, too, have shown confidence, increasing investments in equipment and infrastructure, suggesting optimism about future economic conditions. However, there are underlying concerns. The housing market, often sensitive to interest rate changes, has shown signs of cooling. Higher mortgage rates have dampened home sales, impacting related industries like construction and home goods. Additionally, while the job market remains strong, there are signs of a potential slowdown in hiring, which could affect consumer spending in the future. The international economic environment also plays a role in shaping U.S. economic prospects. Global supply chain disruptions, geopolitical tensions, and the economic policies of major trading partners can all influence domestic growth and inflation. As such, the U.S. economic outlook cannot be viewed in isolation, but must consider these external factors. Looking ahead, the Federal Reserve faces the challenging task of navigating between supporting growth and controlling inflation. The recent data suggests that the measures taken so far are starting to have the desired effect on inflation, but the path forward is fraught with uncertainty. Key questions remain about how much more interest rates need to rise and how long they should stay elevated to ensure that inflation is brought under control without stifling growth. In this complex landscape, the role of fiscal policy, including government spending and taxation, will also be crucial. Policy decisions in areas such as infrastructure investment, healthcare, and education could provide additional support to the economy and help mitigate the impact of high interest rates on consumers and businesses. As we consider these developments, it becomes clear that the U.S. economy is at a critical juncture. The interplay of growth, inflation, and interest rates will shape the economic landscape for months and possibly years to come. The question that looms large is whether the current trends can be sustained and if the U.S. can indeed achieve the elusive soft landing that policymakers and economists hope for. Given these factors, We are left with a thought-provoking question. In a world of economic uncertainties and complex challenges, how can we ensure that growth benefits all segments of society while maintaining economic stability? Share your thoughts and opinions on how we can navigate these challenges and what measures could help sustain inclusive economic growth.